First of all, I'd like to thank everyone for being here. My name is Stephen Sneed. I'm the CEO of Magnolia Petroleum, and I've been instructed to go through this slide by slide, but I won't try to bore you with all the gory details because you can read as well as I can. One of the things I would like to make the point about Magnolia Petroleum is even though we're traded on the AIM market and all of our assets are in the United States, in Oklahoma and North Dakota, we are a revenue generative, cash generative, asset-backed company, oil and gas company, which is saying something these days. We acquire leases in North Dakota and Oklahoma and in areas where we see prospective drilling going on, and we try to get into the plays of the bigger companies, Devon, Chesapeake, et cetera. And you'll see how we do that in just a minute. But that has allowed us then to participate in wells that they are drilling basically non-promoted. When they go to drill a well in which we've been able to acquire a lease for one reason or another, then they have to propose the well to us, non-promoted, and they have to treat us on a fiduciary relationship as a non-operator, and that gives us the opportunity to take advantage of all of their work in drilling a lot of these wells that we have. We have both conventional and unconventional resources. As you can see, we have 202 producing wells in which we own an interest. Now, our average interest is 3% in the working. Some of it's 0.5% and some of it's 100%. But the reason that we like to have a smaller percentage over a larger number of wells is risk management. The best way to eliminate risk is diversification. So which would you rather have? Would you rather have a 3% interest in 100 wells or 100% interest in 3 wells? Well, then you can see what your risk is. And we'll go on to show you a couple of things about the way the company is structured. If you notice I am the largest shareholder, and when I say me, I mean me and my family investment company is the largest shareholder in Magnolia Petroleum. And that's unique for a couple of reasons. I'm probably the least paid CEO on AIM. I have no salary. But my interests are 100% aligned and structured with the stockholders. So that's where I'm going to make my money because that's where I see that you are going to make your money. What we try to do is to find areas where oil has already been found. There's an expression in Oklahoma that best place to find oil and gas is where it's already been found. So we find these proven areas, and then we may kind of worm our way in by means of acquiring leases, which is our expertise. I spent a number of years as a landman buying leases for the major oil companies, and then I spent a number of years buying mineral rights and royalty interest, which allows me the income to be able to work at Magnolia without taking a salary. But we focus on areas where we see that there's already production or has been production or is in an area that has been proven to be a producing area in one way or the other. That gives us some really attractive economics, and we get in there early. Now, one of the things I'd like to point out on this slide is you can see right here when we went on AIM at the very end of 2011, you might as well say the beginning of 2012, we had assets of $1.53 million, P1 assets of $1.53 million. We had 7 BOE/PD of daily production. We had $10,000 a month in revenues. Now, since beginning of 2012, basically 3 years, we now have 21 million in P1 reserves. We have $180,000 a month over the last 6 months we've averaged in revenues, and we have over 300 BOE/PD. Yet when we went on AIM, our stock price was 0.55 of a P. It's now 0.45 of a P. All right, that's why I'm here. Someone said, why is your stock price so low relative to your assets? And I said, well, I guess because people need to hear the story. So here I am telling the story. You can see that in 2013, our revenues were $2.4 million from oil production, oil and gas production, excuse me. And for the halfway point in this year, we had $1.1 million. Now, keep in mind that that's about 40% of the oil price we were getting in 2013 too. So we expect the full year 2015 to be pretty close to what we had in 2013 at 40% of the oil price, which shows you that we are building reserves in the company. People continue to ask us about our cash and debt. Here's those numbers. And what we basically do is take every single dollar over and above what it costs us to operate the company. And as you can see, I'm all about keeping the cost of operating the company very low. And every single dollar that we get over and above what it costs us to operate the company, we plow back into additional wells and increasing the reserves and the revenue of the company. This is our growth since we went on AIM in terms of number of producing wells, our reserves, and so forth. And you can see we're a growth company. Not something you see on AIM a lot in terms of just steady, constant, stair-step growth, but that's really what we are. And it makes us kind of unattractive in some ways, but in other ways, that's what I've said we were going to do all along, is we're going to build value in this company. And that's what we've done. One of the things that people have asked us is, how in the world are you doing at 45 barrel in oil? Well, number one is we're making less money than we were at $100 a barrel. But we have, the U.S. oil and gas business is very adaptable. I have lived through 6 of these downturns in the oil and gas business. This is my 6th one to live through. And every single time the oil prices went down, I acquired more properties, as many properties as I could beg or borrow the money to acquire. And then when we came out of that slump, we came out of it a lot better than when we went into it. And I've made a lot of money doing that. So what we see $45 in oil is as an opportunity to buy more deals, to drill more wells, because well costs have come down tremendously. See this falling rig rates? A year and a half ago, it cost us about $750,000 to drill a conventional well on where most of our acreage is. And today, that same well will only cost you about $500,000 to drill and complete. On the horizontal wells, where we're drilling the Woodford shale and the Mississippi lime, those horizontal wells were costing us $3.2 to $3.8 million a year and a half ago. Those same wells, we've received AFEs, which are well proposals, from operators on our desk now for $1.6 million to $2.2 million. So those costs have come down by 50%. Now, this is an interesting slide because what it helps you to appreciate is that the oil and gas price do not always correlate. They used to. Years ago, we used to say, well, oil and gas prices run tandem, but they don't anymore. There's been a disconnect in that for about the last 10 years. And so what we have done is over this last year, basically this year of 2015, as oil prices dropped to the floor and stayed here, we've been getting more well proposals for gas wells on the acreage that we own. And so what we've done is we've looked at the economics of that, and we've seen that their gas wells in the short term we believe are going to be more economic. And so we have participated in more gas wells recently, which has upped our gas to oil ratio. And so we started the year at 70% oil, 30% gas, and we're currently at about 60-40. We announced today that the first well of the 10 wells that we're participating in with Continental Resources in the United States in the Stack play in western Oklahoma are liquids-rich gas wells, and so we expect that to increase our gas reserves to the point where we will probably be 50-50 by the end of the first quarter next year. This is an interesting slide because what it helps you to appreciate is the potential that Magnolia Petroleum has. We have right now 600 potential drilling locations on our current acreage position. Now, what that means is we have both locations that we've identified as being prospective for conventional well drilling or vertical wells, but we also have a number of positions that are available for horizontal drilling. Now, we are a licensed operator in the state of Oklahoma. We've drilled a couple of wells ourselves. We operate about 4 wells. What we have done is we've elected to only drill the conventional wells ourselves as an operator and to allow the big boys to drill the horizontal wells that require fracking and a tremendous amount of engineering data. And so we have right now 11 as of today when we announced that the Continental well has spudded. We have 11 wells that are currently drilling or in some stage of completing. And again, those are wells in which we are a non-operator. We have a small percentage of interest. But we have 30 wells. One of them shifted from here to here today. But we have 30 wells that the operators have proposed to us and said, you have an interest in the acreage where we're going to drill our well. You have this percentage. And so do you want to participate with us in the drilling of this well or not? And we have agreed to participate in an additional 30 wells. Now, the operators may or may not drill all of those wells. Some of them may have a cash crunch problem and they may decide not to drill it, but we expect that the majority of those wells will drill. We know that 9 of them are going to be the additional wells that Continental Resources is going to drill, and in fact they're drilling those back to back on this acreage in the Stack Play in Oklahoma. So we expect, we've drilled 26 wells so far this year, means we participated in the drilling of those with other operators. We drilled one ourselves, which was a dry hole. And people say, well, you drill dry holes. Look, I'm going to tell you, if you've been in the oil business, you are going to drill some dry holes. Now, the thing about that is we limited our risk because the dry hole costs on this well were $160,000. So what we're going to say to you is that no one well is going to break us. Now, the converse of that is no one well will make us a billion-dollar company, but no one well is going to break us either. But had that well come in, why, it would have been probably a 30 to 100 barrels a day well, like we drilled was the first well we drilled, came in about a 30 barrel a day well, and still today is producing 12 barrels a day, just steady as a rock. So we have, there are as many as 8 wells being drilled per spacing unit in Oklahoma and North Dakota. And as I said, our average working interest is about 3% in these wells. One of the things that we've done to try to keep from diluting ourselves by taking equity is that we have created a banking facility, a credit facility with a local energy bank that loans us money on our reserve. It's a reserve-based lending at 4% interest. So where does Magnolia go in the future? Well, we continue doing this. We continue participating in wells on our acreage. We may drill some conventional wells ourselves. We're getting so many well proposals right now, though, that we are committing our dollars to stay with those non-operated wells for the moment, simply because it's holding acreage. So all of these wells are continuing to hold additional acreage and make it what we call HBP, because all of our non-producing licenses have a term on them. We can renew them in many cases, but we have to be careful and watch those expiration dates. But we're participating in those as much as we can. We expect that in the first quarter of 2016, we are going to see some bolt-on acquisition opportunities. Now, what do I mean by that? We think we're going to see some opportunity to buy some producing properties that have upside. We looked at a deal like that last year that we actually had a purchase and sale agreement on that was $12 million. Now, the bank was going to loan us $8 million of that acquisition at 4% interest. So that looked like an awesome deal to us. When we did do our due diligence on it, though, we found some hair on the title of the deal, and we decided not to progress with the deal and close on it, which, of course, now looks like very fortuitous that we didn't do that. But we believe that after the first quarter of the year, or first quarter of 2016, we're going to see some of those opportunities that we may decide just have a tremendous upside, that the bank will loan us a large portion of the purchase price, and we can bolt those on and hopefully grow the company. What I like to say is that by doing this, we're growing the company by taking the stairs. We're just taking it one step at a time, and it's not sexy. It's not really, it doesn't really turn people rich overnight, but what it does is it builds value in the company. But when we find a bolt-on acquisition, we'll be able to take the elevator instead of the stairs. And that's the way we look at it. There's a street, by the way, in one of the towns nearby where we have some leases called Magnolia Street. So we just wanted you to know they've already thought about us up there. Rita Whittington is the Chief Operating Officer. She is, I don't know if any of you have ever met Rita, but she's been around for 37 years, and she is a lot better looking than I am. I just want to say that right off the bat. But she was with a company called Primary Natural Resources that built up and sold 2 different entities, Primary 1 and Primary 2, and they made a lot of money that time. She was an asset manager for those companies, and it's my pleasure to partner with Rita. She has a tremendous amount of experience and has really helped negotiate some very interesting contracts with us with some of the major operators who are participating, like, for example, Continental Resources. We're, as a non-operator, most non-operators are required to prepay their drilling costs in advance, drilling and completion costs, the entire cost of the well in advance before the well spuds. Rita's negotiated agreements with most of the companies where all we have to pay are dry hole costs, or just the cost to actually drill the well, not complete it, and then they bill us as those other expenses are incurred. But with these 10 wells we have with Continental Resources, we're able to just be billed for them as the expenses are incurred, and we're not have to prepay. And all that's because of Rita's negotiating abilities. These are the non-exec directors, and we just added this year Gavin Derek Norman is our vice president of accounting, and he was with Chesapeake. He was responsible for billions of dollars in asset divestitures and acquisitions with Chesapeake. So we feel like having him on our team is a nice acquisition, and he's going to help us with some of these deals, bolt-on acquisitions we're going to be looking at. Also, we added Thomas Wagenhofer this year as a non-exec director, and Thomas was with Macquarie Capital, as many of you know. He has tremendous U.S. experience, worked in the U.S. for various oil and gas companies for over 15 years, and has a lot of international experience. I find that a lot of companies, when they're evaluating a deal, whether they want to participate, a lot of capital companies, here in the UK, when they are evaluating an oil and gas deal, they will call on Thomas to evaluate the deal for them. So we feel very fortunate to have Thomas on the board of directors as a petroleum engineer, as a non-exec director, and he was instrumental in the deal that we did last year. We saw, talk about an acquisition, we saw an acquisition that, I've got 5 minutes left? Okay, wow. We saw an acquisition that was $65 million, had tremendous upside potential. Now, we're a minnow trying to swallow a whale, trying to do a $65 million deal, but we thought, let's make a run at it. Thomas was able to connect us up with a Dubai company that really did like the deal and actually ended up buying the deal. Unfortunately, they didn't want us involved in the deal because they wanted to operate it themselves and they wanted to run it their own way, and some things we didn't quite agree with. So they basically paid us $1 million to allow them to go ahead and buy the deal. And so Thomas brought us to that company, but that's the kind of deals that Thomas and people at Thomas can help direct us to. Well, that's really all I have to say. You're going to get extra time for questions, I guess. That's really all I have to say about it at this time.
Gentleman there with a hand up.
Stephen, it doesn't seem very long ago that the oil price was $10. Your trading results to the end of June showed a substantial loss.
Yes.
What's your current monthly cash burn, please?
Our current monthly cash flow is
burn.
For the first 6 months, it averaged $180,000 a month. And
Outflow?
Inflow, cash flow in from revenues.
Even though you're making gross losses?
Well, we make gross losses because we drill wells, okay? And those well costs are factored into our loss.
Yeah.
All right.
But you're reporting a loss.
Yes.
So that loss must be paid for, surely, by a cash outflow.
Yes. we raised $1 million in early this year.
Yep.
And so, or £1 million, excuse me, I'm sorry. We raised £1 million early this year. And now, basically, we're revenue generative. Like our average monthly revenue is about $180,000 for the first 6 months. And in our interims, we show that our G&A is $75,000 a month. And then our lease operating expenses are $71,000 a month average.
Okay.
So the difference between those two is what we're investing, but we also invested an average of about $158,000 in CapEx, and we averaged another $22,000 in well workovers and recompletes, refracking some wells.
Okay, but you are reporting a gross loss?
Yes, last year we reported a profit.
To the end of June?
Yes, that's correct.
Okay. Second point is, what's your break-even point on dollars per barrel?
We've announced 33. I would say 34, 33 in some sense. It's $34 a barrel approximately.
Okay. Thanks.
Thank you, Chris. Gentleman down the front.
Got a few questions. This year, 2015, your share price has fallen quite dramatically.
Yes.
What can you put that down to? Low oil costs or?
Lower oil costs mainly, and not just the lower oil costs, but the outlook for oil prices. The outlook for oil prices is just terrible. Nobody believes oil prices are going to go up anytime soon, which actually is good because the more people believe that, the better chance it has of going up. But also the second thing is we drilled a dry hole. We drilled the Shimonik well, and it was the dry hole that I talked about earlier. And so I think that caused some people to say, oh, this company drills dry holes, so, you know.
I noticed one of your non-executive directors, Gavin Burnell,
yes.
was connected with Globo and a
Yes.
couple of other companies that have suffered with financial problems.
Yes.
Have you had a spin-off from that, or will they, have you got connections with those companies?
We have no connection whatsoever with Globo, except that Gavin is a non-exec director with Globo, or was. He resigned last week and is a non-exec director.
Was.
But let me say this about that. Gavin is a very fine person and one of the nicest and finest persons that I know, and was shocked to find out some of the things that were going on with Globo. And he's the only director that I knew that the minute he found out something was going on, he flew down there and tried to see what he could do to help sort things out. And to me, that just speaks to the kind of person that he is. And we expect to see no fallout ourselves from Globo unless some people try to connect us with that, but there is no connection.
Thank you. How many of your wells are solely yours or joint ventures?
We have the Roger Schwartz well that we operate and the Solomon lease that we operate, which has 3 wells on it. Those are the ones that we operate, and we have 100% working interest in those wells. The rest of the wells we are non-operated working interest.
Okay, fine. Are your wells all in the States, USA, or global?
They're all in North Dakota and Oklahoma.
Why are you listed on the AIM then?
Why are we on
Why are
AIM?
you listed in London on the AIM?
That's a great question, and I appreciate your asking that because I get asked that all the time. And people say, why did you come to AIM? And the answer to that is I didn't. AIM came to me. But here's what happened. Back in 2007, many of you know I also own mineral interests, and I was getting offers to lease my mineral interests up in North Dakota. And I went up there and saw what was happening, and I saw something's going on here. They were drilling some wells in a field called the Parshall field. They were drilling them horizontally and fracking them and getting 2,000 barrel a day wells. Well, I bought some royalties up there in one county, but in another county I saw where Marathon was drilling a fairway, and I said I couldn't buy any minerals there, but I could buy some leases. And so I bought leases out of my own pocket, $1 million worth of leases, and I said I'm going to participate with my own money in the drilling of those wells. Well, I get a phone call from a guy whose mineral interest I had bought in Oklahoma City. He said, I have a friend in London who's an attorney, and he has a client who has a plus quoted cash shell. It's looking to reverse into some U.S. assets. Are you interested in being a public company? I said, no. And so he said, well, let him come talk to you. So I said, sure, I'm willing to talk to anybody. I'll talk to anybody about any time, about anything. I have nothing to hide. So Gavin Burnell came over to see me. He had a company called Fairholt Resources that had about 600,000 pounds in it. And he said, we can reverse it into with your leases, your company. I had this little company, Magnolia Petroleum, separate from my mineral interest to drill wells, participate in the drilling of wells. And he said, at the time, he felt like that we could raise several $1 million to acquire more leases and drill more wells. I knew what the Bakken play was going to become. Because I spent a lot of my own money on minerals. I bought over minerals in over 600 square miles of what later became the Bakken play when there wasn't a single well on it. When I sold those in 2012, there were 700 wells on it. So I knew what the Bakken play was going to become. And I said, boy, if we can get some money to make some investments in the Bakken play now, I said, let's do it. So we did that. We did the merger. We tried to get ready to go on AIM, which I don't know if any one of you has done this before, but it's an exhaustive process to take a company with U.S. assets and a London-based company and try to get everything done to where you meet the AIM requirements. We did that, and I came to London April 1st of 2009. And it was April Fool's on me because there was no money going anywhere in London in 2009. So we then said, all right, let's take the 600,000 pounds. We had about half of that left after we paid all the advisors. You know how that works. And so let's take that and participate in some of these wells. So we did. We participated in some of the wells. Some of them we had to farm out to other companies. And then we were seeing some wells in Oklahoma on some minerals that I owned. And so I just gave the lease to Magnolia on those minerals and let Magnolia participate in the drilling of those wells. One of those wells was a well in the Mississippi line that Chesapeake Resources drilled, paid out in 3 months. So we saw some potential in the Mississippi lime at that time. And we had drilled by that time. We participated in 23 wells. 22 of the 23 were economic successes. So we said, all right, let's go back to AIM. We went back to AIM. We were able to raise $1.2 million pounds, $2 million, half of which went to our advisors to get on AIM. All right, and so then we've raised a little money since then, and we've been following our strategy of participating with every single. We bought some acreage, which is where we spent some of the money, and then we've participated in all of these wells ever since, and that's how I got to AIM, and you know, I didn't really come to AIM, but AIM came to me, and here we are. We're partners, and I'm going to stick it out.
I think the London markets, the Canadian markets are very friendly to exploration companies and resource companies, whereas the American market isn't. So
if you go to try to raise money as a small company like Magnolia in the United States, it's very difficult to do that. There's no real public market for doing that. You've got to be a $500 million company before they'll even look at you as an oil company. So AIM was a very friendly market for people that felt like they were a very small company that felt like they could grow it. Unfortunately, I discovered that a lot of what I see with AIM is that people feel like they want a company where they're going to make 1,000 to 1 on their money, but they only have 100 to 1 shot of making it. So they'll spread $100, $1 in 100 companies is what I see with some investors. But I hope that people recognize that what we're doing here is building value in a company. But I hope that answers your question about why I came to London.
it's interesting you mentioned about Globo earlier. Globo was actually presented at one of these events, and so did Quindale, Rob Terry from Quindale. We put these events on so you can actually listen about the company, but sometimes it's just nice to look at the whites of the eyes of the presenters and talk to them and find out what they're really like. And to be honest, if you actually talk to the CEO of Globo and Rob Terry at Quindale, you might not have invested in the companies. And that's why we do these events, so you can talk to the people that run them. So, any more questions, gentlemen at the back there?
Steve, some of your sort of comparator companies have got involved in Egypt and Indonesia and other places. Are you planning to stay onshore US as your focus?
Well, let me say this. I think you should only get involved in something that you understand. I only understand U.S. onshore oil and gas business. Now, if we had the right personnel, and of course, you see we've added Thomas, and Thomas has international experience, so what may happen in the future I can't speak to. We have no plans at this time to go anywhere but onshore U.S. It would have to be with the right person, right personnel who really understands what they're doing before we would ever even consider that.
More questions, anybody? Gentlemen here. Whilst the microphone goes there, could you just paint a very brief picture of where you see Magnolia in 3 years' time? As a majority shareholder, where would you like to see it in 3 years' time?
Well, what we said all along is we were going to build the company to hopefully to around 100 million, and then we were going to assess whether we would sell the properties or whether we would continue building it from that point forward. But in 3 years' time, if we haven't reached it by then, we've done something wrong.
Thank you.
You mentioned earlier that you didn't draw a salary.
Yes, sir.
And you have, I think I read right, 19% odd of the company. If you're growing the company by issuing shares, that's going to dilute you terribly.
I know that. I know that.
So how do you plan to counter that personally?
Well, that's why we got the line of credit. I mean, let's do everything we can, but dilute ourselves. The only reason we feel like we're going to dilute ourselves is if we feel like we can take $1 and turn it into 3 or 4. If we can do that, and we have no other recourse for the money, that's what we'll do. But I understand, and I would a whole lot rather have a small piece of a really huge pie, though, than a big piece of a really small pie. So I've known all along that we were probably going to have to do some dilution, but not to run the company. See, we're not taking equity money to pay anybody's salaries. And that's what I think is the difference here with Magnolia is we've got revenues now that are paying all of that. And so we're not going to, from the very beginning, we were like, let's not take equity to pay people's salaries. We're taking it to invest it into more wells and more reserves.
I noticed you're involved with some other companies. Are any of them providing services to Magnolia?
You noticed that what?
On your when it mentioned directorships,
yes.
It mentioned you're involved with at least one other company. Does that company provide any services to Magnolia?
Are you speaking of Interlex?
I can't remember the name. I just
right.
went up on the screen very briefly.
Interlex is my minerals company, and I I own 100%, my family and I own 100% of Interlex. That's a minerals company. And Magnolia gets to have a corner of Interlex's offices. It does pay some rent, but it has actually the other way. Interlex provides services that Magnolia doesn't actually pay for. So I'm still kind of subsidizing Magnolia a little bit with my Interlex company, yes. But Interlex is not making any money off of Magnolia now.
Final question.
How are you incentivizing the rest of your directors and staff? I mean, you've got a big interest in the company, but
Yes.
if you're not, paying well, how else are you keeping them keen?
Well, Rita Whittington is paid a salary, and I don't want to say that we're not paying well. I mean, we pay her, and we pay her a fair salary. It's not the best salary I don't think that she could get if or she could have gotten, and maybe right now it might be the best she could get, current market in the United States. But she's certainly well worth the money that she's paid. We do have a vice president of accounting, Derek Norman, who's paid a salary, and we have Brooke Greer, who's our land man, who's paid a salary. Those are the only three people that are paid salaries in the company.
One cheeky last question then.
Last question?
Yeah, go on.
Going back to your drilling method, do you have an interest in any horizontal drilled wells or not?
Oh, we do. In fact,
Oh,
about
okay.
50% of those non-operated wells are horizontal wells.
Right, okay.
Okay.
Thank you very much. It sort of answered my question. I was going to ask if it was short-termist, not using modern technology rather than old-fashioned one.
Yes,
Thank you.
we're doing that too. Okay.
Thank you very much indeed.
Thank you
Stephen.
very
Thank
much.
you.